You're listening to Lender Lounge with Kevin Kim, a podcast dedicated to the private lending industry. I'm Kevin Kim, and my goal is to sit down with key figures in the private lending industry to talk about their business and their personal lives. We'll get their takes on market conditions, the industry at large, and their personal stories. Overall, I really want to learn more about how they started and grew their businesses. So whether you're a lender, a borrower, a vendor, an investor, or anyone just interested in learning more about private lending, this podcast is definitely for you. Thanks for tuning in and enjoy this week's episode of Lender Lounge with Kevin Kim.
Have something new for us?
Of course, but better. Magical, self-healing loan pixie dust.
Pixie dust?
Magical pixie dust.
And it does?
You just sprinkle it on your loan, and it does absolutely everything from start to finish.
Everything?
Oh yeah, everything. If a new loan comes in, sprinkle pixie dust on it, and everything is funded.
How does it know what loan to approve or how to pay?
Did you not hear about AI?
What about communications? Texting?
Oh, it knows.
What about borrower docs?
Or dealing with credit checks or appraisals, titles, fees?
It deals with it all.
So you mean we won't have to work anymore?
Never again.
And if something goes wrong, who handles client care?
Nothing will ever go wrong, obviously.
Sounds too good to be true.
That's not even the best part. Biodegradable, cheap, runs 24/7. And you won't regret it.
Heck, let's all go to the beach.
There's no such thing as LOS Magical Pixie Dust. But we have the next best thing. Presto, Next Gen LOS by Liquid Logics. We are simplifying the industry, saving you time and money in your end-to-end loan process, and bringing all the pieces of private lending to one system. Now, we can't promise you won't have to be involved along the way, but we can promise you won't regret having Liquid Logics on your side.
All right, guys, welcome to another episode of Lender Lounge with yours truly, Kevin Kim. Today, we have a very special guest, Beth O'Brien with CoreVest. Beth, please introduce yourself to the audience and tell us a little bit about the company.
Great. Hi, I'm Beth O'Brien. I'm the CEO of CoreVest. And I was kind of expecting at Lender Lounge that I would get a little jazz or something, like some background music, but I guess we're not going to get that, right?
Oh, you'll get a nice guitar riff when we start the show.
When we start? Okay, good.
We have all that great stuff set up.
I want to feel like I'm in a lounge. I was going to come with a cocktail, but
you should do that.
I figure we should be serious. We should be serious for this because I'm very, very serious. No, you'll see that I'm not. Look, I started CoreVest almost 8 years ago now. It's pretty amazing, actually. And I had, it was coming from having started another private money lender that people thought I was really early on in 2011. So I've actually been doing this for 11 years, which for me doesn't seem like very much time because it's been so much fun, but
gone by, right? It's just
in this particular space, that's like OG status, right?
Oh yeah.
In a really bizarre way. 11
years. You guys
ago.
came out in 11. I mean, that's it. Private lending is like dog years. It's crazy. Like
it really is. And it's funny. I used to say to my husband, "Wow, there's a revolution once a year." I think it's actually once a quarter right now. So whatever we say today is going to be out of date by next quarter. But that's kind of one of the things that keeps me so excited about the space is that it iterates nonstop.
It's very dynamic.
So, it was, I think, a great idea at the time. A lot of people have had the idea. People have come in and out. But it is so clearly an important part of the market now. And I think my thesis then, which is still my thesis, is that this is really an important asset class and it deserves its own financing. And it really didn't have it right? There was
So
commercial,
I want
there
you to
was
give us
residential.
the 30,000 foot view of CoreVest today, and we're going to go into the 2011, your thesis, and all the evolution. But we still need to.
Oh, sorry.
What is CoreVest currently? Are you guys? I know you're a private lender. We know you're a household name, but give us the. You got to give us the 30,000 spiel real quick.
Yeah, 2,000 feet. 20,000 feet. Sorry. I'm so granular that 2,000 is my 20. Sorry about that. If you knew me, you'd know just how granular I am.
Oh, this is good. We're going to have fun with this one. I can tell.
So here's the thing about CoreVest. We focus maniacally on originating private lender loans and really being in the market. And we can get to that in the evolution of the company or things like, but we really believe we have a bunch of people in the company, a lot of DNA that is actually investors, right? Mm-hmm. Our COO was in charge of acquisitions at Colony American Finance. He bought the first 20,000 homes. Like, this is something we personally have done. Mm-hmm. And I was also very deep into that space. So maniacally focused on the front end, but then not only do we have our own system for sourcing, underwriting, and closing those loans, we don't sell, right? We securitize our own loans just to match fund, and sometimes, or we balance sheet the loans. All of our bridge loans are currently balance sheet. And I still own, my intent on the day that we are sourcing and closing that loan is that we own it the day that it pays off or refis. Right. And we do. And so we are, I believe, the largest or maybe the only private lender in the space who is really cradle to grave, who is the portfolio manager on the
your size, I would agree. I think at the size that you guys are currently, how big is the company?
We balance sheet everything. Like, we have everything on our balance sheet is $4 billion, right? I mean, it's actually a very large number because we've never been a seller. Like, if you were in one of our early securitizations, I still hold the first loss piece on that securitization.
But that's an interesting thing, right? So $4 billion now? I mean, it was like, I think it was, what was the number we're talking about?
I'm saying that's what's on the balance sheet because things pay off. No. When I'm saying how much
in origination?
I think, it's around 12, maybe
12 billion in originations. This CoreVest was founded in 14, correct?
Correct. The very end of 14. So the very end of 14.
Right. So 15-ish.
Yeah.
So 14, that much.
First securitization was 2015.
Right.
Like, the first real book was 15.
But so so a lot of our listeners didn't know that. That's really, I'm glad we discussed this. CoreVest at its core is still a retail direct origination shop. You are not a, quote unquote, Wall Street aggregator. You're not a buyer.
We have purchased loans opportunistically. We do. It's a small percentage of what we do.
Your primary business model is not.
Right. Primary business model is direct origination and then hold. Like, if you were with me in 2015, with the first 5-year loans we did, they just paid off this past year. We had 2 bonds pay off in the past year. And I was still holding 100% of the risk on both bonds.
Right. And that's something that the audience also needs to understand, is just because a company securitizes doesn't mean they lose control. If you're the one controlling the securitization.
Right. If you're the first loss piece, you're still holding all the risk of the securitization. Right. We securitize to match fund, not to offload risk.
Right. Credit risk transfer is still there.
Right.
It's definitely something that's a balance sheet play. All right. So we have an understanding of CoreVest's current business. And
I think of myself as a portfolio manager. Like, I think of myself, what I'm trying to do is generate high quality assets and be the portfolio manager of those assets.
Right. Now, what asset class? Because this is what CoreVest is known for today, right? You guys want to probably what I would consider.
So we are a full life cycle. Yeah, we're a full life cycle lender, which I think is not as well known maybe as the fact that we do the
construction, bridge.
We do construction. We do we don't really call it bridge loans. We call it the short duration book, which is bridge loans, but a lot of it can be different strategies. It's kind of 6 or 7 different strategies. We do a lot of build to rent in the bridge book, which is basically a construction loan. We do a lot of renovate to rent, which is the other strategy is the more diversified strategy, which of putting people in, but it's still aggregation,
right?
And it's still value add along the way,
right?
But we also do fix and flip and always have,
right? And you'll do that. You'll do that across the country, and you're also very well known for the DSCR 5-year and long-term product.
Correct.
And so really cradle-to-grave lender as well, right? You can pick a
Yes.
builder.
So 45% of our bridge book perms out to one of our longer loans.
Right.
So those clients are with us because there's more than one product that actually suits their needs.
Right. And so let's talk about kind of now. Let's take that historical step back, and it's 2011. You
Right.
know, this is you came out of Wall Street. You were at Goldman.
So I was at Goldman for years, for about 10 years, and then I was at Citi. I was at Goldman doing only commercial and mostly commercial distressed. A lot of commercial loans, all commercial activity. Then
what years was it in the 90s?
Yes.
Oh, so you were heavily involved during like the Asian debt crisis and.
Yeah, in fact, two of the biggest transactions I worked on were buying directly from the Thai government, buying directly from the Korean government, all the distress.
Oh man, you and I should talk privately about that.
Yeah.
My family, we have a lot of stories to tell about the IMF crisis in Korea.
So I worked on we made a large investment when I was at Goldman in Camco. I'm not in Camco, in Goodman Bank, and Camco is running part of the bad asset sale in there. So I spent a lot of time in Seoul investing in Goodman Bank.
Seoul in the 90s during the IMF crisis. It was a very interesting time.
Yes, and the early 2000s. So I was there for a while.
Nice.
Very, very fascinating. Anyway,
so but that's a totally different world.
Totally. And all the stress loans. Although what's interesting is I built a lot of those companies from scratch. So if you're familiar with the crisis at the time, there was no such thing as a secondary debt market. There was no such thing as a special servicer. There was no. So I literally built our loan servicers from scratch in Bangkok and Seoul. So you're
doing a lot of the process building from a new. It was a new venture that they were going at.
Exactly. And so we did a lot of the fundraise. I did a lot of the fundraising, and we brought in clients, and we had proprietary money in it as well. But actually setting up all the infrastructure in those various countries to deal with the loans was something that I worked on, and set up a lot of these things from scratch. So I've been almost my whole career, I think of myself as a business builder. Someone who walks in, sees an opportunity, usually associated with loans. But everything in terms of the servicing, the systems, the due diligence is something that I was helping to architect. And then would sit on the boards of these companies. Like I sat on our Thai servicer for a while. I was in Bangkok once a week for these board meetings, right?
But the idea of servicing didn't really exist.
It did not exist in Bangkok.
So you have to teach them this is what you're supposed to do. Like literally, like at the granular level, you're supposed to collect payments, and you're supposed to do this, and you're supposed to
this may be too much for your listeners, but I think it's actually a really good it informed the way that I think about lending and business building, if that's what people are interested in.
Yeah, and but there's a good analogy there, though, right?
So when we were building the servicer at Bangkok, we were the first winners of a distressed loan pool that the FRA, which was the Thai restructuring company, was selling. So of course, I mean, as all of us business people know, when you have an auction and you're the winner, it messes with your mind a little bit. Like you want to win because you're bidding on the assets, but you're the high bid, right? So there you are. You're the high bid on, $1 billion of bought loans, and there's no such thing as a servicer in Thailand. So you set one up, and it's Goldman Sachs, and we're trying to look for a partner. So we got into business with GECC, which had a moped servicing company, moped loans.
Somewhat similar.
We thought it was the closest thing we could find, Kevin. Okay, we're like moped loans, real estate loans. They're pretty similar.
Yeah.
So we do this joint venture with GECC, which is, market leading. Goldman Sachs, arguably market leading, even though we never purchased there before. We set up a company from scratch. We're going to the operating companies of the firm at 4 a.m. and doing our pitches. We get everything. Everyone's assuming we're ticked and tied. We have an army of people working on this. So we open up our doors. We have a hiring fair. We have all these procedures. We open our doors at 9 o'clock in the morning in Bangkok in our brand new offices. and people just start showing up with bags of baht, right? Like literally bags of cash. And we had set up everything because we were so American. Right? Or at least our institutions had, even though we were all working in Asia and we had all these institutions, we'd set up everything. We figured we were going to get checks, wires, credit cards, like whatever people pay their mortgages with here. No, everyone was so excited. They'd heard this pool was bought at a discount. No one had ever offered them a discounted payoff before. And they literally showed up with so much cash. We had to shut the company down within an hour because we physically couldn't store the cash. It was so much.
Right.
And it was so dangerous.
Right.
So we had to shut the entire company down and start again, like in 2 days with armed guards, Brinks trucks, and all these cash process. We had no procedures in place for cash. And so what it does is it reminds you that no matter how much work you do to set something up, you can have whatever thesis you want, you can have whatever idea you want to start a company, you are going to make some big mistakes. The key is, can I react fast? Can I figure out what my mistake is? And can I adjust and move on?
Right.
And it wound up being a very successful venture, but we had to completely rethink and not be wed to, well, we set up these procedures and they're going to work.
And how much of that was improvisation, right? Because the 2-day turnaround. You have a 2-day turnaround.
We were back up and running and we had everything we needed.
So like the idea of improvise, adapt, and overcome, right? The having to improvise that, okay, well, we have all this cash. What do we need? Like the idea of having to think on your feet. And it's fascinating to hear an entrepreneurial mindset at an institution. I think that does work.
Particularly those two institutions. I mean, GCC is like Six Sigma.
Right.
Which is fantastic. I think it's a really highly skilled organization, but to be able to react quickly, even within those organizations is key.
Right.
And so you take that to starting a private lender or starting another business. What I always tell people is you will make some big ass mistakes right away.
Right.
Embrace them. Like that's okay.
Yeah.
Just react fast enough and don't be led
what is
to
it? The quotes that I live by is it's about how enthusiastically you can get back out after you failed. I mean, that's what the definition of success to me is.
Before we move on, I really want to tell you about a great sponsor that's joined us for the show. Spiegel Accountancy is a national professional accounting firm specializing in tax, audit, and fund administration with over 20 years in the private lending space. Using an industry expert allows the fund manager to ask tough questions, such as, what are the accounting and tax impacts of loan loss reserves, delinquencies, or foreclosures? As a trusted CPA source for the private lending industry, Spiegel ensures clients' financial reporting meets the highest standards. For more information, head to their new website at spiegel.cpa. That's SPIEGEL.CPA. Spiegel is your strategic and innovative accounting partner.
So how does one transition from a distressed corporate credit and mortgages and commercial and working with the governments of Thailand and South Korea, and then all of a sudden jumping into the residential mortgage space in the United States?
Here's
very different markets.
Right, very different. So, I came back and, it looks really nonlinear in my career, except now it looks like I did it on purpose. I came back, I wound up going to Citi on the residential desk, even though I had never really dealt with residential mortgages. But I had a close friend and they were looking for somebody. I went in, I thought I would just interview and wound up getting this job, right? So I actually spent the early part of the crisis, the mortgage crisis, on this mortgage desk. Now, because I had done so much distress work, all of a sudden when everything fell apart, everybody on that desk was much smarter than me, much better at structuring cash flows, much better at everything that you think of as like a resi mortgage desk. But I was the only one who knew how to foreclose on a property, get a hold of the assets, what a third-party sale was like. I already knew from distress, right? And the residential market had never really seen that type of distress. I knew how to consolidate servicers. I knew
at
how
that
to
scale either. I mean, oh my God,
right.
Yeah, because it was something that you did usually third party, right? The institution typically third partied everything.
Except for like the cash flow modeling of the things. Nobody really expected individual mortgages to be important. Everyone, like I was that person who, like, if you watch The Big Short, was always like, aren't we going to site visit? Shouldn't we drive the assets? Like I was so used to the commercial mindset on distressed assets, of touching each asset and seeing each one, right?
Right.
And so when the crisis really hit at Citi and so much of the desk was gone, all of the bad assets came to me. So all of a sudden I was managing down the rock pile of like 4 billion of bad assets, dealing with the treasury, working through and I wound up working through auctioning off assets because we couldn't sell the REO fast enough. It was like a falling knife, right? Which is how I got associated with auction.com. And wound up being one of their bigger clients. I gave the reference when they took an investment from the outside. And then a couple of years later, when they decided to do a loan sale program there, I showed up on both the screen from auction's perspective and from their private investor, because they had spoken to me at length about when they made the investment. And so I wound up going there to start their loan sale program and started auction finance. We saw in the auctions that there were all these people on the steps, all these people trying to buy the real estate, but the debt capital markets hadn't caught up yet.
No, I mean, it didn't exist.
All equity.
It was 100% equity back then. And if it was debt, it was your friends and family type.
All friends and family.
True hard money from back in. That's what it was like. I mean, we have plenty of clients that started the business that way. So, I mean,
so we had this thesis that we got half the money from Stone Point Capital, which was the main investor in auction.com, and then Starwood, which was one of their through L&R, which was one of their close relationships on the commercial side. And we started a private money lender, mostly to help facilitate the sales at auction.
And what year was this?
This was in 2011.
Wow. So was this the birth of,
right. I called around to a bunch of other private equity firms at the time. I'm like, are you guys interested in coming in? Because we were clubbing it up. It wasn't, auction finance wasn't 100% auction.com. And everybody was like, wow, Beth, interesting idea, but so early. You know, like people were shocked that we were going into debt lending that early. But it was quite.
And this is a good theme. This is a common theme on the show, right? We discussed like when Wall Street started to look at the space. And we know that generally speaking, they jumped in at around 14, 15. Yeah. But you're raising interesting points because of your history and your previous career. You were able to solicit Wall Street investors, institutional investors as early as 11. What was it? It couldn't have been yield. I mean, yield was high back then, but it
was not yield. In fact, at the time, I was convinced I was going to do 10 and 2 across the board, which was actually really light to market at the time.
Yeah. Yeah,
it was actually light. It was like a 12% market. It was like a 12 and 3, like
on a national average, 12 and 3. Right. Yeah.
Like I had this very flat rate. I had this whole idea of doing it very cookie cut. I've always been somebody who tries to do things in a way to scale.
Right.
Our chief operating officer likes to call it burger, fries, and shakes.
Yeah, I heard you say that when Nima interviewed at one of our conferences. Yeah. Like, and I want to talk about that. I mean, but so when
that's really important to getting things smooth. Like I'm really about no friction, but that's a whole
simple standardization. Every time, every loan's going to look and feel
modular. Every piece of paper. You'll appreciate this as a lawyer. Like every one of my docs is the same, unless you want to give. Like I do things in a very prescriptive way, so that when we get to securitization, we're not redoing everything. We're not.
Right. You're planning way miles and miles.
I'm doing stuff at closing that affects my securitization asset management. People are not as.
It makes it smoother for everybody. I mean, that makes it easier to hire, makes it easier to train. That's fantastic. But this is funny because you're thinking of this. You're thinking of this in 11 when the market barely existed.
It was me. It was Gregor Watson, who was doing this at 643 Capital, and Robert Wasman, who was doing it at Genesis. Like the three of us were like it.
Right. And there were
plenty of people doing it. Lots and lots of people doing it in their markets.
Yeah. At the local level, at the courthouse steps.
We're doing it in more than one state, more than one location.
Right. Because even the larger retail operations that were kind of like funded through high net worth investors and had their funds, the ones that we've known over the years have talked about their experience in 2011 and very much being you just kind of make it up as you go kind of scenario. And there was no consideration of standardization back then because every deal was so different. But you're coming to the market in 11, not only with institutional capital, but also standardization. That was it, right? It wasn't the institutions were okay with it because you're going to make it. You're going to standardize it for them. You're going to make it.
I was standardizing it. I was willing to do reps. Like I remember I had somebody come on site for a warehouse line. Remember, warehouse lines were non-existent for this product at that time. And I had somebody
for many years to come. Yeah.
And I had somebody come on site, one of the, the three main money center banks was willing to do it, came on site and they're like, wow, Beth, you have a custodian. Like I had my docs at the custodian because I grew up in an environment where you would do stuff like that. Your average hard money player
You weren't thinking about that kind of stuff.
They weren't thinking about the custodian.
Yeah. I mean, not just custodian, but understanding, being willing to make reps and warranties, being willing to commit to certain production qualifications, understanding the fee structures. It was a kind of a growing up of the industry. Today, it's all kind of,
I was already diligencing for securitization reps in 2011, even though I've never even done a bridge loan securitization. But I would never make a loan that was unsecuritized.
What did you guys call the assets when you were talking to the institutions back then? Because to them, the challenge that I've heard other lenders tell us about was they didn't quite understand the asset class either. It wasn't a mortgage, a conventional mortgage.
We were basically calling it fix and flip. In fact, we were so focused on the takeout. Right? Like as a lender, one of the things that's really important to you is, are you going to get paid back? Because on a good day, on your best possible day, Kevin, you get par.
Yeah.
Congratulations. You were perfect to get par. You never get par plus, right? Like, so you got to make sure you're getting paid back. And so we were really focused on takeout. We actually wouldn't do rental loans. We had a policy against it at that time, just because we didn't know what the takeout could be for a rental loan. That market hadn't developed yet.
Yeah.
And so we really were only financing people that we could see the turn. Like, did they have experience actually selling the asset in the required period of time?
So let's talk about that. So what was this? This is now Colony, right?
Yeah.
Okay.
So at that point, it was auction finance early in 2011. So what happened was Colony was one of the people I went to for capital at the time who thought it was too early. In 2014, they called me back. And they're like, Beth, remember when you came to us, we're going to start a lender now. We now think it's a good idea. Will you come and do it? And I said, no, I'm not going to California. But here's three names of people who would be really great for you. I really like the job I'm in. And then, 2 weeks later, no, we really want to just talk to you. Could just come and have a conversation. I was like, no, really, like also proving another point. If you're not interested, they really are interested in you.
Yeah. Wait, so 2011, 2014 is when the industry came out of the primordial ooze, in my opinion. And we starting to see some grown-ups come into the space, and the industry started really starting to get serious in 13, 14. And, one of the interesting parts of that was, auction finance behind the scenes was probably shaping the stories for a lot of the lenders out there who were trying to compete at the courthouse steps.
Yes.
We weren't seeing a lot of like heavy kind of like nationwide marketing, nationwide expansion. But was auction finance back then? Were you a national lender? That early?
I mean, I don't know how many states you need to be in to be national, but we were in multiple states, both judicial and non-judicial. We were doing it in Georgia, Florida, California, Northeast, like basically
big market states.
Assets. We were doing it in the larger market states. We weren't as national as I am now.
Right.
But only because.
But that was foreign too.
We were following the auctions. We were following.
Yeah. You're following the auctions.
Texas. We were at all the Super Tuesday events. We were at all of the steps in California.
Right. So the market in 14, so Colony gives you Colony's asking you to come. Yeah.
Remember what happened in 13 was that the institutional Invitation Homes did this first securitization on homes. And all of a sudden the debt markets were like, ding, 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 ding. We can do this.
They finally realized this makes sense.
We can do it on loans.
Right. It made sense to them. Everything started to make sense, started to gel.
So all of a sudden you see Cerberus come in, you see Blackstone come in with B2R, and you see Colony come in on the theory that, hey, if we can do this at 100 cents on the dollar on equity and buy houses, how about 75? How about we come in the stack at 75 cents on the dollar? And by the way, with the same yield up front, because we don't have to put someone in the house, you're yielding from day one, right? So you're lower in the risk profile, but all of a sudden you've got this very equal yield.
Right.
Now you're capped at par. You got to get it right. You have to have credit. There's, it's not as simple as that, but it's pretty close to what you would want to do. And so that's why you see the people who were also involved in the equity come into the debt around 2000.
And that was so for a lot of our clients, a lot of our listeners who are kind of newer market entries, forget is like a lot of this was driven by former and the current, massive home buyers or the iBuyers.
It was the fact that they were able to achieve the securitizations. The market wasn't 100% sure you could securitize rental payments.
Right.
Which is they didn't actually securiitize rental payments technically legally, but that's the underpinning is the rental payment.
Yeah, at the end of the day, it looks like
loan, but it's the loan that got securitized, but it's the rental payments that pay it.
Right, and we saw a dramatic, I guess paradigm shift from 14 to 16, when now every institution and their mom were jumping into the space and buying up loans and doing everything they could. Yes. Tell us about your transition to Colony and then rebranding to CoreVest. Now we're going from
Colony called me because they were somebody that I had called along the way.
Right.
And that's kind of one of the nice things about being kind of in and around the space for so long is that, look, we all have conversations with each other. The opportunities present themselves because we do actually all know each other and have been doing business for years together, right? Which is kind of one of the nicest things about this space is that it's so collegial. And most of the principals really do know each other and can have these kind of calls. Anyway, so I wound up going to Colony, starting it from scratch. I actually shut them down right away when I first got there because the first loan they did, this goes back to our other point, the first loan they did was a $3.2 million loan. Probably one of your listeners is going to call me out on it because it was his loan. But I think he paid in legal fees like $40,000 or $50,000 because it was a CMBS loan that had to have a non-con opinion and an enforceability opinion and
on a residential property
in a CMBS loan.
It was a residential property.
No, it was a portfolio of rental homes.
Oh, really?
Yes. It was a portfolio of rental homes, and that's what it cost. And I was just like, I get there, I'm like, you cannot run a business this way.
Yeah.
I'm like, the legal fees have to be like $5,000. They're like, oh, it can't be done, Beth. I'm like, yeah, it can. We have to figure out a way to make this work for the client because it's not a $30, $40, $40 million CMBS loan. It's at its core a small portfolio of residential loans. How are we going to make that work? Right. And so I went out and got 50 enforceability opinions for each state. I went out and got all of this stuff up front and then said, look, here's a loan package that we can close with you that we think is reasonable. That's $5,000. Because we did everything up front, right? Now, if you want to negotiate, you have special circumstances, that's fine. Then we'll take a deposit for the legal fees, which is fine. And so you never tell somebody it's non-negotiable, but you give them something that works. And it's not non-negotiable. You have a package that works and it has 7 or 8 riders that work if they need a certain type of thing that, we're
pre-planning it, basically. You've already pre-planned any kind of random thing that usually comes up. And then if they want something bespoke, then
you may have a different type of bad acts carve out because you're a fund than an individual or something like that. And so what you do is you standardize enough opportunities and enough ways to do it that people are not paying for the friction each time. You're still going to have all the valuations, it's an expensive process to have a large assets.
And going back to the idea of burgers, fries, and shakes, right? The idea of standardization, commoditization, pre-planning is something that as a lot of people don't think about is they kind of go into this thinking, they build as a reaction. Right? So we see a lot of people build their systems and processes and software and protocols after jumping in.
Whereas I shut it down, built it, and then started it back up.
Right. And then so let's talk about that. I mean, was that partially one of the reasons why, or was it the big reason why, Colony, which became CoreVest, was able to scale it, which it did, because you guys are now what I would consider probably, definitely a household name, but, it's you're kind of the standard a lot of our clients are now shopping against, right? And being shopped against. And the name always comes up, whether it be in the DSCR space or be in the short-term stuff.
I think it's because we know how to close these loans and we close them in very reasonable periods of time. You
guys aren't promising like a couple days. You're doing it within
No, we don't do it in a couple days. The rental portfolio loan is gonna take you 30 to 45 days.
Right.
But it doesn't take 6 months like some people do.
Right.
right? There's enough, and we've built a system. Our system, I think I mentioned earlier, really starts from the sourcing. Everything feeds the same end-to-end system so that no one is ever retyping anything. No one is ever doing something specially like what comes in. Like I can tell you on a closing date of a loan what Google word they used when they searched it.
Oh.
Like
so you're not only you're not only streamlining and standardizing the production process, you're also doing it for the lead generation process.
Yes, I also have a feedback loop directly to my lead gen and my originations team.
So they now know what's working, what's not.
Right. So we're constantly tuning. I've been told, and I don't ever see anything, but I've been told from like warehouse lenders or rating agencies that we actually spend less on marketing than most people, but it's because our marketing is so curated.
No, actually, I can tell you from a person who's very involved in the marketing in this industry, like your guys' average market, I see the AdWords stuff online and see how it's structured. Your guys' spend is nowhere near some of your competitors and colleagues, and
but meanwhile, also generating higher lead gen.
Right. And so that has to do with you're intentionally tracking every minus component.
We have a almost daily feedback mechanism, even from I know when I get rating agency feedback, what types of loans are getting me what levels and what type of search was done for those.
So the early on interface is feeding the tail end.
And the tail end is
feeding. And it's, oh my goodness. Okay. Now, that insight is something that's very valuable for a lot of folks who do not appreciate, I guess what I call data, right? They don't appreciate the tracking of data.
Obsessed, Kevin.
And we know this. We are granular.
I'm such a consumer. It drives people crazy internally because I am such a consumer of data.
But it's not. So when we talk about data on the show, right? A lot of people kind of automatically go to like macros and macroeconomics and regional geographical data.
Yeah, everybody who tells me they're into data is talking about what they're buying from the market or what they're scraping from the records. My data I believe my own data is my best data.
So
I'm maniacal about my own data, and I've got 8 years of it.
Right. So that's something that a lot of people
built it in a way to capture the data because I'm so data obsessed. My systems were built in a way that I could capture the data.
And it's putting out reports for you constantly for you to make a decision off of them. But once again, I want to stress to our listeners, this is not like geographical macroeconomic data. This is not appraisal data. This is not.
Believe me, I consume that too. I love seeing what other people are putting out. It's not that I don't read market data,
right?
But what I'm talking about is my own data. I have it milestoned in a way that I have dashboards that I can look at anytime.
Right. So like loan production data, we talked earlier, the SEO and the marketing.
All the way through asset management. My asset management data, I know when a loan comes in, I know exactly which bucket is more likely to default.
And it's showing.
I know what the characteristics are of my loans that have gone sideways, and I'm going to get that red flag on the front end.
And like most companies, one of the common threads that I've noticed, this is, I'm guessing, a bespoke, purpose-built platform. And I want to say software because platform.
It is end-to-end. It is one single platform that I use all the way through. I have some visualization tools on top of it. The platform is not the best at making the dashboard. So you can use, there's plenty of things out there that can bring your data up and make pie charts, that kind of thing. So, but the system itself, I drive people crazy. It's like, I have a single source of truth. If it's not in the system, exactly, and that, like I said, it's the same system that has the lead gen and the asset management system and the servicing data and everything else comes into it. But it's not that it's a proprietary system. It's been, we've made it proprietary by building it out, if that makes sense.
So you bought some kind of like open source or SAS, like SaaS protocol.
It's a normal platform that anybody can buy. It's just that I've customized it.
Customize it to your needs.
Yeah.
Okay. Well, that's good news for our listeners. I mean, because a lot of people, when we hear about larger companies that have scaled to the size that CoreVest has, the conversation always kind of goes around, the platforms that they're using and the software and the tools and the hiring and that kind of stuff. The tool component, typically the story is that they built themselves, right? Because
yeah. So I was against that, having been in a bunch of places. Like, I felt it was important to have something that was cloud-based. We're 100% cloud-based. We went home for the pandemic in 24 hours notice, and there was not a hiccup because everyone was already on a laptop. All of our stuff was already cloud-based, so that was built that way from the beginning. But yeah, no, it's a totally very normal system on purpose, because I've seen too many places spend tens of millions of dollars building out a weapon system that works for the loans. But then, like I said earlier in the program, it's been a revolution every quarter. Like, we're doing different products and we're doing different things than we were doing 6 years ago.
To me, I feel like almost every month, right? Even within fix and flip, you see some variation thereof and some random esoteric product coming out. I'm like, since when do we do this? It's been.
It takes something really simple. We didn't used to do renovation financing. The original fix and flip market was like, that was it. There was no such thing as another advance. Like, ARV was not relevant, right? And so if you had built a system then, you probably wouldn't have. How would you have accounted for the extra draws and the extra this and that? And so that's why I think it's important to have. We actually have we call them agile sprints. If you're into technology, I think everybody knows that. Every 2 weeks, we come out with a new version of our system.
Yeah, you have to.
Literally, it's every 2 weeks. It's not but that's why you chose the system, because it's flexible enough that we can do that. We also have a lot of portfolio loans. So we have a whole asset background and then a loan background, right? Like, many to one and one to many is going to cause you problems in a system if you haven't built it that way from the beginning.
So the challenge that I've identified for a lot of our clients is they don't have the ability to say no sometimes, right? And then they say no, right? But the challenge is, like, the loan makes sense to them and they want to make it work, right? And they're still small enough where they can be esoteric. But then the challenging question, if you're doing that more than once a month, how often does that keep you up at night or keep you delaying? And then the process.
That's a fantastic question, Kevin, because I think every one of us is really an entrepreneur at heart.
Right.
We want to do every loan. That's why
somehow it can make sense, right?
Right. Look, you can always fix a bad asset. You can't fix a bad borrower. So I don't want to do the loan with a bad borrower, but you can, I'm a fan of almost every asset if it has a strategy, right?
Right. So you're planning ahead. So you're building the burgers, fries, and shakes around that, like that fact pattern that's going to come up, right?
Okay. I'm hoping I've got it right. But like I said, I change my system every 2 weeks.
Right.
I'm crazy. We have a low release every Friday night, every other Friday night. Always on Friday.
When you do that sprint, right, and you're building out that new structure or
maybe
product.
It's just a new field, maybe it's a new product, maybe it could be big or small, but it's everybody knows you only have change. We do it in a way that's systematized, so that again, we only do it on Friday nights because we test over the weekend when people aren't really closing loans. You don't want to break your system on a Tuesday.
Right. That's important, actually, right? A lot of people.
And we have this whole set, right?
Right. Once again, though, it goes back to the idea of planning ahead, right? I think the big theme I'm hearing is not planning ahead for consistency. That's what I'm hearing, and it's something that's almost unheard of in our sector. And I think as a credit to you guys' success, has taken you guys very far, because not only is it what attracted the institutions in 11, which was unheard of, right? They weren't going to do, but also what's allowed you guys to scale at the size that you ability have. But there's also a question
without adding the human spackle, right?
Okay, and without having a giant workforce, right? And I want to ask you about that. So clearly, when you came in and joined and started, restarted
Colony, and then CoreVest with,
and then CoreVest conversion, but the company must have changed. I mean, not just names, but have changed from a size standpoint. When you were early, it was what, you and 3 people? I mean, what was the company like?
Well, we did start. There was one warehouse lender who said, really, we're going to lend to them? They're like 3 guys in a Bloomberg. I was like, 2 guys, 1 girl in a Bloomberg, okay?
Hey, you had a Bloomberg.
Bloomberg, okay?
Yeah. You had the curve there. Most of us couldn't afford a Bloomberg back then.
That's $5,000 a month, that Bloomberg. Actually, I was borrowing the Bloomberg from somebody else at Colony, but that's another point. Like,
hey,
so,
someone lent it to you at least. You have a friend that's deep enough to give it to you. But that's the thing, right? The company is 3 people, right? And those are uncommon.
Pretty quickly. We were 20 pretty quickly. You need a lot of different functions. Although,
right.
Particularly Ryan and I, we would just like, I'm like, are you the marketing department this week or am I the marketing department? Because somebody's got to get an email out, you know? And like we were the content people, we were the marketing people, I was head loan closer. They still call me into close. I can still close a loan if I have to.
Nice.
But I think because we did that, it allowed us to really understand where some of the opportunities were when we were building out the scalable machine. Right, when you're building the foundation, because we were so ingrained in it in the beginning, kind of, you know.
But when you're so small like that, and when you're like in startup mode,
right,
being adherent and being strict about those standard systems and processes is challenging, right? And I'm the bad guy here at the office. Like I never fight. I always deviate because I'm so bad at it. But
we're trained to say yes, Kevin. We're trained to say, I want to say yes.
Right.
I am a yes person. If you ask my CFO, he thinks I still say yes too much. But what it did for me though, first of all, our clients are also really brilliant and deep in their stuff. And so by being head loan closer for a few months, I actually really learned from my client. Like, you know, we'd be in these negotiations and I'd have these docs that, you know, some like very important securitization firm had put together for me with, you know, all these different things in it. And I'd be coming back to them going, you know, I just had a conversation with a client and they don't like this provision and that provision for the following reasons. And I kind of agree with them. Like they're smart. They know what they're doing in their business. Do I really need this? Is this really something I need for securitization? And we've been able to, I think because we dug into it, there's still, you know, very complex documents. This is not an easy mortgage, but I feel like we've been able to take a lot of the noise out. And I actually credit some of my really diligent clients at helping me get there, right? Because we did spend a lot of time on negotiating these provisions and coming up with what I think is a clean set. And even things like our, you know, when we first started, the insurance was crazy high. Particularly in Florida, it almost made no sense to close certain loans with the type of insurance we needed. We spent so much time working with the insurance companies on coming up with a PML approach. So we're like, look, if you have a CoreVest client, we're going to have a whole pool in the securitization. If you do enough of this, you should be able to spread the risk over all of these assets that are really nationwide, that are cross-collateralized, or they're in these pools. And they were really looking at it on a house-by-house basis. And we were able to bring down the cost of the insurance dramatically by working with them on just making them try to understand the securitization process better. And so having kind of both sides of this really, I think, helped us make the front end a little more user-friendly. I mean, I'm sure my clients would get on and say, she's not that user-friendly. It's not perfect. We are the lender and they're the borrower, right?
I mean, it's not automatic, whatever you want, but like it's fascinating when I hear about people who are very like kind of standardization and scaling, combining that with that entrepreneurial yes, I want to say yes mentality and balancing it. So like, when was the time when like, you know, okay, you started, I mean, currently, how big is the company now? I mean, you guys have offices, you have New York and in LA, here in Irvine as well. Yeah,
Irvine, LA, New York. But we're still about the same number of people, about 130 people, and that's end to end.
That's it?
Yeah, that includes my leaders, that includes my capital markets group, and all the underwriters and asset managers in between.
I thought it was a lot higher. Yeah, 130 is not that as big as I was actually thinking 200-ish, but that's
a lot of our competitors are. I think it's really a testament to the process and the systems we have in place as being scalable.
So like, how do you guys, I mean, for lack of a better word, enforce these things, right? Because one of the hardest things with this stuff is, you know, you're deviating, right? I do it all the time, right? People get mad at me for it. Like, because I joined the company when we were literally like 5 people, and now we're 30 or 40.
We deviate up front. It's not that we're not trying to innovate and deviate up front and like have conversations and come up with something. But one of the things that I think makes us so successful and keeps our loans closing at a good rate and our total staff numbers at a reasonable number, is that once something gets into underwriting, it has a high 90% chance of closing. So we do that type of work up front before it goes into the system. Once it's in our system and it's going through, it's actually very hard. The underwriter can't really deviate, right? Until there's things in the system, you can't get to the next step unless certain things come in.
Okay, so it blocks them. Okay.
It's all there. It's a workflow. It's managed in a workflow process. And it has everything in one place. I mean, one of the things that's so nice about it, we integrated at Redwood, they had already made a purchase of 5 Arch, right? And so we integrated the two teams. And I remember one of the women who came over, whose job was just, something really simple like valuations, came over and said, wow, I've got 2 hours a day back. 2 hours, because to do I think most people, I don't think this is a ding on any particular firm, but like most people, if you want to get valuations, you send an email with a list of 12 properties or 15 properties or however many it was, and you say, I need the following 12 valuations. 9 of them come back on time, and then you're dropping and dragging into the folders to figure out which 3 you still need, and you follow up with a phone call and such. Everyone in our system, you go in, the property names and addresses are already in there because they came in with the originations. So you don't type anything. You click the order valuations button, right? It's already been QC'd we have a QC thing that checks all the street addresses, make sure they're clean. It goes out to the vendor, who then pushes it back into the system. So when that person comes in 2 weeks from now and 9 out of 12 appraisals are back, they're already in the right folder. They came in through the FTP site or whatever site
right.
was using.
But not only are you making the ordering process better, but it's landing in the right place.
It lands in the right place. There's no drag and drop. It sounds really basic, but no, it's not.
Having to hunt through your Outlook or your whatever your email client is. That's so inefficient.
Email. Right. It's never in her email. It's in the system. And by the way, it's digitized when it comes in, so that if there are fields in there I want to use, they're usable. Nobody's retyping. Yeah.
So I want to kind of shift gears a little bit and talking about the company's culture, because the company has changed so many times over the years. You guys have rebranded.
Our capital sources changed.
Your capital sources have changed. No, but you guys have added people over the years, right? And growing to 130.
We're always
right. And it's such a challenge.
If you look at the people who are running the departments and you look at the senior management team, first of all, the senior management team Ryan and I have been there from the beginning.
Nice. That's very rare.
Have not turned over.
Most companies of your size, the principals are either typically retired by now.
Capital's been there 6.5 years. When we split from Colony American Homes is when he came in, and he's been here since then. Like, people keep asking me, like, why do you have such low turnover? I don't know. I'm not at the other places, but we have very low turnover.
I know this, right? So we don't see a lot of folks from your during COVID, we saw a lot of people moving around and stuff like that, and either at the at the entry level or at the senior level. But the question to you is now that level of stickiness, right? What are you guys doing from an employee standpoint? A lot of the interviews talk about company culture, right? And a lot of revolve around values or client employee appreciation or training. What about you guys? What do you guys think is your thing that keeps that stickiness?
There's always room for improvement. And I think, like our regular system, we're trying to always constantly innovate and improve upon it. I think
so. You can Kaizen approach then, right?
We keep adding things, right? And I do think, one of the nice things about being part of a public company now is I feel like we've been able to roll out more benefits. We've been able to do some of the stuff that's been really important to me. We do have like a profit participation plan. It was critical to me that it go to every single employee on some level, which is definitely something I took from Goldman. There was a strong bias. When I was there for the IPO, every person in the firm got shares.
Nice.
Not the same number, is not the same extent.
Sure.
But and I was actually living in Hong Kong at the time, and there was a big article in the South China Morning Post about the person who was the boat captain on the junk and the tea lady in the office getting shares. Base, right? And so for me, when we rolled out a profit participation plan, it was critical to me that every single employee participate, and not just the senior levels, which, was what came to us as here's the opportunity for a profit participation plan. Would you like it? Would you like it for your senior management team? And I said, well, I'll take it, but only if it goes to all employees.
So balance.
It does not go to everyone. It doesn't go to everyone on the same percentage.
Sure. But there's still financial incentive, right? Even for entry-level employees.
I want people, I don't care what department they're in. I want them to know that if we had a good quarter, they should have something for that quarter. Because who cares?
Right.
Who cares if your employer has a good quarter if you get nothing?
Exactly. What are they working for? And then
everybody's working for a salary and a bonus, but this is independent. This is not related to employee. It's not related to employee performance. It's related to firm performance. And I think you have to have a healthy component of both to really incentivize your employees. Look, I'm as concerned as the next CEO over the next year, 2 years, and the workforce in general in the US. I think is complicated. We certainly, we have a high percentage of employees who were hired when we weren't meeting people in person.
Yeah.
And I want them to feel the same connectivity. It's different, right? And I think all of us as leaders have to spend more time thinking through how do we continue to develop the type of behavior, the type of cohesiveness that we had when we were all 5 days a week in the office.
Yeah, and talking about that real quick, so a little bit deeper on that, like when you talk about a larger company with public, tied to a public traded company and having all these financial incentives, and combine that with remote work, part of it also has to have the level of engagement that you're trying to create. Yeah. We struggle with this here during COVID. The level of engagement you're trying to create with your remote employees, or even just across the country, right? With OC in LA to New York, right? That the level of engagement is very hard to manage and hard to get. And with today's generation, being of a, I guess they're more comfortable with Zoom, right? Whereas I'm pretty bad with Zoom and I hate it. Like I would rather be shaking hands in person. Like, how do you guys manage
nothing
that?
Better than in person. Look, there's nothing better than in person. And yet, and I think that there's a lot of great protocols now where you can do a lot more in person. And we're certainly starting to travel again and start going safely. But one of the things we did actually that we did a bunch of different things. I'm sure you did too. And there's only so many trivia nights you can do. At some point, it's going to get kind of played.
Zoom happy hours. Come on.
Thank you. I can drink by myself with no video.
Yeah, exactly.
I went to college. I have 2 kids in college. The first thing they did when we were locked down, when we had the grocery list, was put White Claw on it. I'm like, what's a White Claw? Right? And my daughter's like, Mom,
during COVID. And I drink it a lot now.
And my daughter's like, Mom, it's like La Croix, but different. Just buy it.
Pretty good.
She's right. It sounds like, just buy it, Mom. But if you're going to lock down with some young adult children, you have to buy White Claw. But anyway, one of the things we wound up doing that was a total sleeper hit. It was really a hit, and we did it as a client thing, but it wound up being this great employee engagement thing. We put together a cookbook on what people did in quarantine. We solicited from and we put together the CoreVest quarantine cookbook, and I couldn't even believe how high a participation it was from the employees. But the thing that was so wonderful about it, Kevin, was that the employee voice came through. So people put these little stories in the email, there's a place near the office where I always got the following chicken katsuya for lunch. And I tried for weeks at home to make it just right until I got it so that I could have the lunch I was having. Or somebody else put together a little business with some of their friends, or there was a block party potluck. And all of these interesting quarantine stories came out through the submission.
That's nice.
That we put into the book. We mixed it all together, and then our marketing department, kudos to them, came up with the most hilarious names for the recipes. We had a drink section and a food section, and bring back Mai Tai was the Mai Tai. Everyone had kind of a COVID pun, but was related to the recipe.
That's nice.
Fantastic.
I like that. Because you're not only getting that like the stories through food. That's one of the best ways you can convey a story is through food, but also you're getting that level of like that extra lower layer of what they're really dealing with as a person.
What it did for the first time too is it highlighted people across the organization. We put together a real book and we sent it out to our clients, and it highlighted people across the organization. I'll send you one. They're so fantastic. But it highlighted people across the organizations that the clients didn't always deal with.
That's so important. Yeah.
Humanize it. And then we had a contest among the employees to who could try the most recipes. So even if you didn't submit one, if you tried the most recipes, you would still get the prize.
Awesome.
So we sent out like branded merch and stuff. And you know what it did, Kevin, that we were missing completely and that all the other stuff wasn't doing? It started getting employees in different departments that didn't know each other or didn't normally talk to each other for business to talk to each other about these crazy recipes, because they're like, oh, I made your pho. Or I made your squash.
Once again, food, right? Food is that unifying factor. That's you found something that, and also it was a big deal during COVID. Like everyone started cooking at home.
Everyone was cooking, and it was something. And we sent home aprons and little that's awesome. Tumblers and stuff to go with it. Anyway, that created the most.
But the thing is, now people are going full. Like we have a lot of clients who basically gone full remote. They have a full remote workforce, a chunk in the office. And they're racking their brains for how do you have this engagement?
How do you do it?
Really wonderful idea.
So you know what's interesting is I heard a fantastic talk that Ruth Porat, the CFO of Alphabet, gave recently, and she said the reason that the great work from home experiment worked was because A, we all did it together, and then B, we had this amazing reservoir of connectivity. That we were really relying on. And at some point you do have to replenish the reservoir. And so we're not 100% remote anymore. We are hybrid, which I think does work. We're looking to recreate some of that connectivity, but also maintain some flexibility. So that's where I think we're all going to struggle over the next year or so, kind of working through.
Agreed.
But in the back of my mind, this idea of the deep reservoir of connectivity is so important.
And are you guys doing that as a company? Like, are you guys, how are like your East Coast operations, your West Coast operations? Because I mean, Irvine to LA is someone you guys can probably create a venue for them to meet in person. New York to West Coast, that's going to be a little bit more challenging. Does CoreVest do anything like to bring all their employees together or anything like that?
Occasionally we do mostly for training. We'll have people travel, which had, fallen off a bit, obviously. Sure. But is coming back. And then
there's nothing better than going to the East Coast with your team. You build that camaraderie while you're traveling. That's cool.
We also do a lot of site visits and conferences, and so we try to staff it so that people from different groups are going.
Oh, that's nice. So then they can prepare together, and then they meet in person. Yeah, that's wonderful. Okay.
But I'm particularly deliberate. I'm deliberate about most things, but particularly deliberate when we have training sessions to make sure it's different groups, different seniority, like appropriate for the seniority. So sometimes it's not different seniority, but different offices and different groups, so that you're not just always with the same people.
Cool. I want to switch gears a little bit. I want to talk about your thoughts on kind of the industry, because one of the people that I've actually wanted to get these thoughts on definitely you, because you've been involved for very long, but also you have a different perspective on it because you've built kind of one of the most recognized brands in the space, but also having a different perspective because of your capital markets background and understanding your balance sheet. You're a balance sheet lender, but you also have a very strong knowledge of what Wall Street wants. And where we are today I feel like it's a weird time. I feel we're in a very weird time in the marketplace because we're out of COVID. It's white hot, right? I mean, it's white hot right now. And
I think this is like phase 3 of the institutional capital coming in, at least.
Okay, so how about that? So tell us about how you view that. What are the phases to you? Because I have my own views on this.
So there was the original phase when people just decided we're going to come in and buy. Right. Because they felt it was a dislocation in pricing in the like US real estate market. But that's back when everybody was saying, is it a trade or a business? And most people thought it was a trade. People thought they were going to come in, buy the distress, flip it, and then it would normalize. So I would say that was phase one. And that kind of
that's buying the houses, to be clear. They're buying the houses.
Right, buying the houses. And there was a little bit of debt going on in them, but not a lot because people were afraid of the debt. So then the next phase, all of a sudden people were like, well, you know, we can't really find any bond. The bond market was kind of dry. And so people started trying to build on their balance sheet, like mini bonds by using these rental payments, right? And so like the next level of kind of fixed income people started coming into the equity space as well. And it wasn't about HPA anymore. It was about, that's when it first started to be about yield. And because there wasn't kind of a good, attractive risk-adjusted yield elsewhere that they could buy and supplement with that.
Right.
Now it's aggressively about yield, but also just there is nowhere else for the capital to go. And because the fundamentals, people are finally understanding, I think it was literally my thesis like 8-9 years ago, is that, you know, we have a fundamental housing shortage in the US. And particularly at the workforce housing level, which is where most of this is. I mean, some of the institutional players are one notch above that. Like an Invitation Homes is probably twice the value house of what I'm financing. But still, it's within range. It's still below the kind of entry-level home builder house.
Right.
And so you're looking at now, people just plain want to play the demographics, which is you have household formation off the charts, you have rents going up, you have HPA, you have everything happening at almost the same time. And it's not that COVID caused it, it's just that it accelerated the trends that were already in the market. It surprised me that this third wave didn't actually happen a little bit sooner.
Yeah, it was actually an interesting thing to me as well. I was wondering, you know, because you kind of look at corollaries in different other mortgage spaces. You know, I look at the commercial space, the conventional space, and I was like, yeah, our space is where we live. So this is an 18, tail end of 18. Actually, no, sorry, tail end of 19, going into 20. I was like, you know, why are these guys still buying up loans? It's all they're doing. They're just buying loans. Why are they doing that? And then COVID happened.
Right.
And then we got out of COVID late summer, right? And then all of a sudden we started seeing larger yield spread, which wasn't a thing in 14. Yield spread wasn't a thing.
Right.
Credit lines started to come out. Master repurchase agreements started to come out. Like the aggressiveness on both the fix and flip and the rental. And to your point is that it's tied to the core fundamentals in the housing market.
Yeah, I actually believe it's real demographic change.
I agree with you.
Demographic numbers that are driving it. Now, I think there's some ancillary stuff in the market, like the evaporation of the hospitality and office space at the same time. So there's all this extra capital, like on the commercial side, that kind of moved towards.
They need a place to put it.
They needed a place for that.
There's not enough industrial to feed all that either. So
you can only do so much industrial.
Right. That causes allocation imbalance. But
right.
But the question with that is
some of those market things happening. I'm not saying it's 100%, but I think at its core, it's a demographic move that was starting to happen pre-COVID, but this accelerated it.
When do you think a lot of like the Wall Street and the financial institutions accepted this asset class as a true asset class? Like, I didn't really think they accepted it.
I think it's really pretty recent, Kevin. It's crazy. I mean, I really, you know, it doesn't feel that long ago to me that I was calling the street begging for a line. And now if anybody could give me a line, they would.
It feels like even like retail banks and regional banks now understand it, right? I'm starting to see more like just regular retail regional banks jumping in on the lender finance side. They're understanding the product.
Yeah, we definitely feel competition from the regional banks. We always have. It tends to be more relationship driven and very local. When we tell people that can get it, they should get it. Like that's really financing. It tends to be lower leverage. And a little slow to play. It depends. It depends on what your goals are, right?
Right, but it's still the fact that they're understanding it, right? And let's throw the fact that they're lending on this stuff aside real quick.
Yeah,
they're providing credit line. More small banks are now jumping into lender finance for the retail for the balance sheet lenders out there, and we're starting to see. And we just saw another bank purchase. You know, we had the Civic transaction, but then we also see the large institutional banks invest heavily in this sector. And
I think what you're going to see, I mean, I think it's no secret that there's a bunch of M&A activity happening over the next several
consolidation
months. There will be either some consolidation, or the other thing I think that's happening is there's such a demand for the assets, right? Like at the insurance company balance sheets, and that's institutional, but particularly the insurance companies who really need assets against their.
And that goes to your point earlier, right? With the commercial stuff, they used to love the commercial stuff, and they can't get their hands on it right now, or they won't touch it.
I think what you're going to see, one of the things that's going to be interesting to watch is if enough of the, everybody knows that there's transactions happening. Nobody really knows where the homes are going to be yet on some of them. It'll be very interesting to see if insurance companies, and I think in a few cases it will be, at least behind the institutional capital, there'll be an insurance company. If they wind up with these assets, you're actually going to see, like right now, there's a really healthy flow of assets into the bridge loan securitization market.
Yeah.
If some of these M&A activities may take those assets off the market. It's not that you're not going to be creating the assets. The assets won't disappear, but you won't see them come back in the securitizations. You'll see them go directly to the insurance company balance sheets. I think that's also going to have some interesting capital markets implications.
Yes. I mean, that's the if you start changing the game from securitization to balance sheet, one additional product that comes from that, unless you're the actual securitizing company,
right,
is the way you underwrite shifts dramatically, and the way you evaluate assets and take down assets and deal with defaults is going to change dramatically, and it's going to change. I mean, hopefully it won't cause a race to the bottom, which we saw early. But
I hope not. I mean, look, the insurance companies don't want bad assets either. Maybe it improves it. I'm not. You never really know what the total impact is, but there's going to be a change coming.
And like you said, right? It's every quarter of this space.
Right. You're going to have this. This is going to be the revolution next quarter. Is where are these assets showing up?
Right.
And does that have an impact? Is that going to impact the front end or not? Right. And you could go either way, but I think that's one of the things that's it's certainly on my mind. Where's the
I want to bring up another one then, because DSCR is another thing where like I've had conversations with people about this from all walks of life, and even my Uber driver today, right? But like talked about
what does the Uber driver think? I always want to know that.
He doesn't understand the fact, like why he didn't understand why anyone would rent their house. I was like, well, hold on. But I think he didn't understand the idea of it as an investment. But from a I guess market standpoint, one of the things that's been brought up commonly, and I want to get your thoughts on this because you guys are so heavily entrenched in the SCR sector, and you guys are kind of the industry leader, in my opinion, is the threat of what I would call conventional mortgage banks in the DSCR product asset class, right? If we were to create that as its own asset class,
right,
the threat of the conventional mortgage banks coming in or competing or creating a challenge, it's been brought up.
So they certainly could. Normally, when I think about a threat like that, I try to believe all entrants are good entrants because it will definitely drive down coupon, but it may commoditize it. It may make it more profitable to do. Like you got to figure out a way that if that happens, that you take advantage of it too. There's something about improved liquidity that's causing that, hopefully, and it's not just a degradation of credit standards. So you try to participate if you can. But I actually don't think the risk is that great on the true resi originator. And the only reason why I think that is because I was pounding on their doors for like a year and a half trying to get them to do this product for me and do it on a correspondent basis, and had a really hard time getting, the mindset wasn't there for it. And so, and I think there's two things. I mean, as you know, there's investor loans that are considered consumer loans that are agency eligible that they're already doing, but where they've been announcing some interesting caps recently, the Freddie and Fannie. And so I think you're going to start seeing those show up in the private market, and you are starting to see those, but they're not the same thing as a DSCR loan, which is one that wouldn't qualify for the consumer delivery. right? Either it's an
It's
LLC
probably
or-
going to be the limitations of agency because they're going to have to find the institute, and you guys already have the access, and that could be also be the what I call the hurdle to entry for them.
Yeah, it's actually really hard to get one of these conventional lenders to even focus on this.
Well, yeah, because it's
not
easy access to Fannie, Freddie, Ginnie. Why not, right? I mean,
There's so much more going on. Yeah, there's so much more going on in the agency space. It was hard for us, even with large incentives, to get them to get any traction.
Well, that should give some of our listeners peace of mind. We've had this discussion, and going to the idea of, I guess, inventory. We talk about this, and everyone harps on inventory, right? And I want to get your thoughts on inventory and where we're headed with this. One of the concerns that I bring up on the show that I've heard over the past few years or so, past year or so now, is the inventory challenge, right? How are we going to deal with this? We're not building at the clip that we used to, even compared to the 80s. We're not building enough houses. As a space, we're growing by leaps and bounds as an industry, but we're just not doing enough to build the inventory we need.
So here's what I think about inventory. Obsolete housing stock. So you're on the West Coast. You're on the West Coast. You don't see it as clearly like some of the East. But like there is literally what I would consider obsolete housing stock on the East Coast. There is so much opportunity to repurpose stuff that's just not livable. That's either urban infill or one step removed from that. Like where I'm seeing a lot of the inventory opportunity is not in the primary and even secondary cities right now.
Tertiary market.
Yeah, I mean, we have a fix and flip client, a relatively brand new one. People are like, oh, you're not going to find any new fix and flip clients. There's no inventory. They're in Pittsburgh and it's working, right? They've done 70 flips in like 7 months in Pittsburgh, which is not, maybe you can't get 70 done in Philadelphia right now, but you might be able to do it in Pittsburgh. Or, there are different markets like New Haven where it's a fantastic rental market, but there's a lot of older home stock that.
But when you say obsolete, though, that sounds to me like you're tearing down the actual units and building.
You don't have to tear it down. You could renovate and rent. Sometimes people got and rent, or they could tear it down and build something new. I actually do believe there's plenty of opportunity. It's heavier lift. It's not just like a lipstick flip where you just change the carpet and the paint.
Right.
It doesn't look like HGTV.
Right.
Because it's not grand with a swimming pool and everything, but there's a lot of opportunity in those markets. And I think this is another one of those, I think, COVID effects is that the B- markets are becoming pretty attractive to people.
Yeah.
Because they can be there. And all of a sudden it's not B- anymore. You're getting a lot of property or you can rent something.
They can afford it.
Yeah.
I mean, they can afford that. That's also the challenge of inventory. I mean, we started to see areas here in Southern California that you would never buy a home in 3 years ago. Now it's becoming kind of a cool place to live. So, I mean, same dynamics on the East Coast, I'm sure.
Yeah, I mean, look, if we're financing in LA, it's almost always a multiplex. You can't get the yield with these values unless it's a multiplex.
So this idea of obsolete kind of repositioning.
Bringing it back to the housing market, basically. Your first-time home buyer, even though the stuff is inexpensive, your first-time home buyer doesn't have the capacity to get in there and then put the renovation dollars in.
No.
They really don't, and do it in a way that's actually going to make it really habitable.
No, they want to. They want to, but most first-time home buyers.
Most people want it to be turnkey.
Yeah. I know I did when I first bought my first house.
And people don't mind renting now. Like there's a different mindset in renting too.
And I want to get to this because renting is a new topic lately. That's been a very interesting one. I've been hearing this on different types of content platforms that I've been listening to are we becoming a nation of renters, right? Instead of a nation of buyers.
We'll go back to my White Claw crowd.
Yeah.
Because they're my focus group when I need these. Look, they want to go to a wedding. It's rent the runway. They don't even need to own the dress. They rent the dress to go to their friend's wedding, right? They rent like it used to be my parents' generation. You didn't lease a car. You owned your car, right? Now you'd be hard pressed to know which car in which driveway is a owned car versus a leased car.
Right.
And I really believe that's rental does not have a stigma associated with it anymore. Literally, if you're renting your dress for the wedding, You can rent your house and be on a street where some people own it and some people rent it, right? And I think it's just a totally different mindset. They'd rather make an investment in a REIT if they want real estate exposure and stay mobile. And you can stay mobile. It doesn't mean that you're not investing in real estate, or that, maybe they may be more likely to buy a house, rent it out, and get the income, but rent their primary residence. So
and I had noticed, I see that too as well. Talked about, I listened to some, another podcast where there was a gentleman on the show. He doesn't own anything. He doesn't live. I mean, he doesn't own his home, but he owns a bunch of Airbnbs, and that's how he makes his living. And that's an interesting paradigm shift that's tied to the kind of the gig economy of the world today. And that's a fascinating way to look at it. I mean, it's not necessarily a bad thing. People have been this new generation has been ingrained with being comfortable renting, and that's okay. And there will be people who want to buy homes too, maybe as investors or maybe as their first home.
My White Claw crowd got their driver's licenses a little later than some, at least my son did, just because he kind of likes Uber. What's wrong with having somebody else drive you?
Right. Yeah. I don't need to, I can work around it almost. That's an interesting way to look at it. I guess the challenge.
It feels less burdensome to some people. I'm not saying
that's what I hear a lot too.
I'm not saying that homeownership isn't a fantastic thing. It really is, and it's when it's appropriate and the right time and everything else. I hope the homeownership rates are going up, but like I said earlier, we have this dramatic housing shortage, and shouldn't we be funding affordable housing into the housing shortage any way we can, where it's the best livable asset?
Right.
And a lot of times, having somebody renovate and rent is going to provide the best asset for that class.
Right. I think that's also important because you have a severe lack of workforce housing in most markets, and the ones that are, subsidized are just a bureaucratic, awful mess. And so we do, that's part of what this industry oftentimes needs to focus on. I think is the contribution to affordable housing, contribution to workforce housing. And maybe that'll help our friends in Washington give us some breaks and give us some better treatment.
We were part of the Freddie pilot a couple of years ago. And one of the things that they had as part of the pilot was that the loans had to be 80%, AMI. They had some affordable housing goals that were part of it, which we thought was very good. We went back and back tested our portfolio. We passed the test and we didn't even have a copy of it.
Right.
We were already basically right on the 80%. We didn't have to adjust any of our programs to make the Freddie program work. And so I think that's what people forget, is that we are actually financing a really important part of this market, and not just financing it, but when you finance it and you have these and you do the bridge loans ahead of time, and you're financing, making it really habitable.
Right.
Our best borrowers, I'm sure you've seen the same thing, are putting a ton of rehab in, because they found very quickly that if you do something shoddy, where you lose money the most in this business is on the turns. Right? If you're doing heavy repairs and maintenance, or you have a tenant move out too quickly, you want long-term tenants, low repairs and maintenance is really going to be what drives your NOI over time.
And that's going to be the best way to get NOI, return on investment, especially for this kind of asset class. And
100%, that's the most important.
And we really need our industry to understand the importance of that contribution and highlight that, because we're doing it anyway, like you just said, with the
renovation dollars up front, though. It's the renovation dollars up front that drive that.
And we're providing that.
And yes, doing the most work up front are actually driving their own bottom lines the best by putting in the most dollars up front.
Right. Okay. Well, I want to ask you our last question, and that's going to be all the time we have for today. Next 3 years. Not going to say long term. I don't want anyone crystal ball for that long. Next 3 years, bullish, bearish.
What is that? It's 12 revolutions.
That's 12 revolutions. That's true. For the next 12 revolutions, bullish, bearish for private lending market?
Oh, I'm super bullish.
All right.
Super bullish. Mostly just because I think it's a demographic shift.
Yeah.
More than anything else. I think the numbers really bear it out. I think we have a lot of great other factors happening, but if you really spend some time with the demographic data, you're bullish.
Awesome. All right. I like it. so far we haven't got a single bearish yet. So
Yeah, well, that's also, well, then we may need somebody to find a bearish pocket or something so that we don't.
maybe I'll find my most
Find a baby bear. Yeah, find a baby bear, or maybe at least a Goldilocks. I don't know.
maybe. All right. Well,
thank you so much, Kevin. It's been a pleasure.
Thank you so much for being on the show with us today, and we'll see you out there. Are you going to be at a trade show anytime this year?
Yes, I've started going back, so I'm looking forward to seeing people on the road.
All right, sounds good. Thank you very much for being on the show today, and this is Kevin Kim for Lender Lounge. We'll see you on the next one. Thanks for listening to Lender Lounge with Kevin Kim. I hope you enjoyed this episode as much as I did. If you did enjoy, please leave us a 5-star review on your podcast platform, and be sure to follow our show to be notified of new episodes. If you're on YouTube, don't forget to smash that like button and hit subscribe for more content from all of us here at Gerasi. Lender Lounge with Kevin Kim is available on all podcast platforms. Referrals really help us spread the word, so please send this over to someone you think might enjoy it. See you next time. This is Kevin Kim, signing off.